Welcome back. I am in Darjeeling in the Himalayan mountains today. Darjeeling is a city mountain retreat in India, and it's clouded right now, but those you see amazing mountain peaks from the Himalayas when the clouds do separate. So today we're going to talk about or put forward the argument that what makes empires fall is not losing battles, but debt crises. And I'm going to talk a little bit about Rome and Spain, but I'm really going to focus on Britain, because I think Britain has the most analogy to the U.S. and some of the problems the U.S. may or may not have. I don't think it will anytime soon, because the U.S. is very different from where Britain was after the Second World War, but we can talk about that a little later. So let me start off by saying, and I've said this before, so I apologize if I am repeating myself, but in finance, the only thing that counts is bonds. Nobody cares about equities. Most people think that Wall Street is about equities. It's not. It's about bonds. The big boys play in bonds. Pension funds, endowments, even hedge funds, they play in bonds. Now, what are bonds? Well, go look it up. But basically, bonds are a kind of loan. So they invest in the loans, which makes them basically the investor. And if you think about my 0-hour work week model, the basic premise I put is that within 20 years you can have financial independence and do things like this, become a modern nomad and travel all over the world and live all over the world through financial independence, and you can achieve it in 20 years or less. And how do you do that? You buy strips of cash flow. When your cash flow is multiples of your cash outflow, when you've hedged it for inflation, when you have some growth built in, then you are financially independent, and you can go into part two, which is pursuing education and culture and realizing all of you. So that's the 0-hour work week model. Now you'll notice that I talk about strips of cash flow, and strips of cash flow come in many forms: promissory notes, direct loans, mortgages, etc. But today I'm going to talk about bonds, which is a kind of strip of cash flow. So the important thing to understand is that countries can't issue equity, right? You can't own a country, so they have to issue debt. The problem is that countries start spending more than they earn, and they can't figure out that they're spending more than they can earn. It becomes a fixed cost, and they can't cut their costs fast enough. And that has happened historically to a lot of countries. If you look at it, that's what happened to Rome, that's what happened to Spain at one time in the 1500s, certainly the richest country in the world, and then it happened to Britain. So this has implications for the U.S., but we'll talk about that a little later. So let's discuss the concept of a reserve currency, because that's very important. So after London took over from Amsterdam as the financial capital, the Brits, by the turn of the 20th century, the 1900s, had the reserve currency. Now what that means is a reserve currency is like an international currency that most people use to settle their accounts. So let's say today the reserve currency is US dollar. So what does that mean? It means if I want to buy a barrel of oil, it trades in dollars. A trader of oil will not take any other currency. So what does that mean? It means you have to have a lot of dollars sitting around. How do you get a lot of dollars sitting around? Well, you can certainly purchase the dollars on the open market, but that's kind of expensive way to do it, and it's not sustainable. What you do is you sell something to America, and America pays for its imports through dollars. So then you keep those dollars around in the central bank, but you got to invest in something. So what do you invest it in? You invest it in the safest asset available, because you need that foreign currency, and that is U.S. government bonds. Now, the cool thing about a reserve currency is that it gives the country that has a reserve currency a real advantage. And the advantage is people basically have to hold their debt. That is to say, if you want to pay for oil, if you want to pay for copper, if you want to pay for magnesium, all metals markets, all energy markets, almost every global market will only take dollars. And you have to store those dollars in dollar-denominated asset. And if you want the least risky dollar-denominated asset, you got to invest in dollar bonds. Now, one of the reasons reserve currency is because once something is used as a reserve currency, there's very little default risk. What does that mean? It means there's very little risk that they won't pay you back. Why is that? Because they can always print money. So U.S. bonds pay interest in U.S. dollars. So if America issues more bonds and there's a problem, they can always issue more dollars to support their bonds, to pay the interest, to even buy back their own bonds if that's necessary. And that's why America has the advantage of having almost unlimited debt capacity. People, all else being equal, will always hold American debt. So Britain was in that position, and you can see some of the clouds in the background there. Again, it's very high up in the Himalayas that we are. So Britain was in that position, and in 1914 they were by far the reserve currency, in a position to fund their empire. Now, by 1919, so 1914 and 1919, Britain went from a creditor nation that lent money to people to a debtor nation, which means that they had to borrow money. Why? Because World War I was expensive, and they went bankrupt, basically, issuing bonds because their revenues were greater than their expenses for World War I. So guess who who lent them the money? Primarily America. Now, Britain did something really stupid, which is, I believe it was in 1934, if I'm not mistaken. They couldn't pay their debt, so they reneged on their commitments and didn't pay back America for the debt that America had given them. Now, the reason this is stupid is because people aren't going to lend to you in the future if, in fact, you haven't paid back the bonds that you issued in the first place. So guess what happens? World War II happens. And Britain goes again, hand in hand, to America. And America says, well, I'm not going to lend to you. And for the longest time, America didn't lend to Britain, until it looked like the Nazis might win. And so America created this idea called the Lend-Lease program, which is just nothing more than basically helping out with the debt for Britain. So they gave them a second chance, which isn't always the case. So Britain now comes out of the Second World War, and they have even more debt than they had before, after the First World War. And they can't pay it back. Now, the irony and how pathetic Britain was by the end of the Second World War is two of their largest creditors after the U.S. were India and Canada. So their colonies, and a dominion in the case of Canada, actually was lending them money. That's how pathetic Britain was financially. Well, in 1949, Britain had a major currency crisis. People just refused to keep their bonds. They dumped them on the open market. Why? Because they didn't believe that Britain could pay up. Now, Britain did start issuing interest payments in British pound sterling, but at some point they didn't have enough money, so they devalued their currency by 30%, I think it was. Now, the moment they did that, everybody holding gilts, holding the debt of Britain, just lost 30% of the notional value, which is the amount that they borrowed, overnight. And the value of any interest, if it was fixed, is worth 30% less. Now, one of the reasons that happened is because America ran some really, really tough terms the second time around. They said, look, you got to make the British pound convertible to US dollars. So since Britain wasn't doing very well, holders of gilt bonds, that is bonds denominated in British pounds, converted their bonds into dollars, and that is what precipitated that particular crisis. So when they did that, they lost the global reserve status, and America became the global reserve currency because people were converting their money into U.S. government debt. And then America became the largest economy, and ever since then, the U.S. dollar is the reserve currency. Now, Britain was so pathetic, and they had so generous programs that they couldn't afford, that in 1992, again, there was a currency crisis. They were booted out of the ERM, which was the European exchange rate mechanism. And George Soros made $1 billion shorting the British pound. Shorting means you make money when something goes down. So he bet that the British pound would go down. Why did he bet that? Because they're deadbeats. They can't pay their bills. Their revenue is lower than their expenses. And Britain had a lot of labor governments, and labor governments, like a lot of left-wing organizations, love giving quote-unquote free stuff. And of course, nothing is ever free. So at some point, your creditors won't lend you any money. It's like if you spend more than you earn at home and you fund the difference with credit cards, at some point you're going to hit the credit limit and you're going to have a problem because you're going to have to make some very harsh cuts to your expenses. In the case of a country, you have to cut social programs, and for a democratic country, that's really difficult. You're going to lose power. So in 1992, that was a coup de grace. They basically completely lost any semblance of financial respect. And to this day, Britain is a shadow of what it once was. Now, the implication for what I just said is that history is driven by finance. And wars are always financed. Why? Because wars often cost much more than you expect. What you should be doing is raising more money if you're going to fight a war. So you should be raising taxes or instituting, not necessarily income taxes, which I, as you know, don't believe in. You could raise sales tax. You could raise property. There's a lot of different taxes you could raise, but you basically should fund any liability, but governments in democratic countries don't like to do that. They don't like raising taxes because that will mean they won't be in power anymore. So my contention is that as honorable as it was for the freedom fighters in India and a lot of other countries to fight a war of independence, if my theory holds true, if my premise is correct, then India would have gotten its independence anyway if they had just waited to let the power of compounding do its thing. Because if you had some smart economists, and I'm sure they did have smart economists, but maybe they didn't have sway, they would just say, look, their balance of payments is horrible, they spend more than they earn, they're not going to maintain their currency status, and we just have to wait. So India got its independence in 47, and Britain devalued and lost its reserve currency status in 49. So they had to wait a few more years, 2 more years in fact, and it's quite likely Britain would have pulled out. So what is the implication here? The implication is that countries lose their empires not because they lost a battle, but because they run out of money. They can't pay their debts. So you take Palestine, for example. Britain voluntarily pulled out of Palestine. There was no great Leave Palestine movement. They pulled out. Why? They couldn't afford it. In fact, they pulled out of a lot of their international commitments. France eventually pulled out of their international commitments, even though France was never the reserve currency, or it certainly wasn't in the near term. So what implications does that have for the U.S.? Well, I'm pretty bullish on the U.S. There's a lot of differences. First of all, Britain was a small fraction of the global economy in 1914 in terms of GDP. The U.S. is still depending on how you count, between 20 and 25% of the global economy. So it's a very large economy. Neil Ferguson has something, he's an economist that some of you might have heard of. He has something called the Ferguson effect. And he says empires start crumbling when the interest payment on debt is greater than their defense spending. Well, right now in America, soon, if interest compounds, America is headed for the interest rate on their debt equaling their defense budget. Hasn't exceeded it, but it could quite likely exceed it. So that says that's a warning sign for America. But the difference is that America still has the ability to maintain its contracts, to basically collect when somebody nationalizes something, or a country nationalizes something. They can send in troops. And so they can enforce their commitments, and the U.S. government bonds are still, therefore, among the safest currencies, and their obligations will be met through military force, if nothing else. America's our larger economy, and I would say relative to Britain, which had its empire, but it didn't have the dominance and the number of military bases that the U.S. does. It is far more dominant. And I think the most important thing is America really has no competitor. We hear a lot of talk about China. And I heard something that was kind of an exaggeration, but I found it funny when India and Pakistan recently were shooting missiles at each other. An Indian commentator says, those are just Chinese toys up there. They're not serious weapons. India actually makes its own missiles, and in collaboration with Israel and a whole bunch of other countries. And I honestly believe there's some truth to that. You cannot even compare the dominance in technology and the actual military might of the U.S. and the economic power of the U.S., the cultural power of the U.S. It's very funny when I'm here to see people having Yankee T-shirts on or Bulls T-shirts on. They probably don't even know what the hell the Yankees are, but they wear them. What does that say? It means America has a cultural influence. China just doesn't, right? When was the last time you put on a T-shirt of a Chinese basketball team? Doesn't happen. So America has a lot going for it, but America has to watch out. It has to cut expenses, and to the extent that Trump is trying to do that, that's a good thing, because America needs to cut expenses. The problem with Trump is he's not a fiscal conservative. So I'm not sure what a priority it is for him to cut expenses, but you've got to cut expenses. So that means you've got to cut regulation, get rid of a lot of government civil servants, and to a certain extent he's trying that. But unfortunately he keeps on spending to offset some of the cutting, and that's kind of what Elon Musk has a problem with. So let me sum up by saying this. If you want to be financially independent, you got to be in the cash flow strip business. That is to say, you got to be in bonds, you got to be in promissory notes, you got to be in mortgages, i.e. as a lender. That's where the action is. That's where the big boys hang out. I like to make fun of my friend Sanjay. He thinks he's smart because he's been in a bull market and he buys a leveraged index fund that's levered to the S&P 500, I think it is. Who cares? Nobody cares. What matters economically is how much cash flows your assets generate. The definition of an asset is net cash flow, i.e. the value of your asset minus the value of your liability. That creates net cash flow. Cash flow is net of debt, right? If something doesn't generate cash flow, it's not an asset. If you own a house and you live in it and you don't rent it out, it's not an asset because it doesn't generate any cash flow. So with that, I'll leave you with an interesting hypothesis, which is, could it be that a lot of these independence battles were unnecessary? Could it be that the power of compounding could have created independence for a lot of these countries from Britain by just waiting? Something to think about. I'll see you next time.